Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, with the market seeking direction, earnings season kicking off, what kind of impact is earnings season for the first quarter going to have on the market? Our experts are going to weigh in on that issue and a couple of others. Research Director Shiraz Mian, ETF strategist Eric Dutram, and market technician Kevin Matris joining us this edition of the Roundtable. So, Eric, I'm going to start with you because actually you think that it could put, Q1 earnings season could put a little bit of a drag on the market. For you, it all gets down to two questions.
Definitely. I'm going to be looking at tech and financials. Financials have been really strong in the past couple of earnings seasons, but according to Shiraz's latest piece, it looks like they're going to be in for a rough quarter this time around, and they've kind of been leading the market on the earnings front. And then also some of the big tech names, such as Apple, Google, they obviously account for a big portion of total earnings, and they're also forecasted to have a weak quarter. So it's going to be a real question for these two sectors. If they can kind of turn around and beat these predictions, could be better, but you know, there's really not much going in either one of these spaces.
So for you, it's can financials keep up their momentum? Is tech going to be as bad as people expect?
Exactly.
Okay. Shiraz, could Q1 earnings season be a test for the market here?
Yes, it could be. And what could be the test? The test would be how the expectations for the coming quarters evolve after the market hears from management teams. Remember, the expectations for Q1 are quite low, at about 2.5% earnings decline from the same period last year. But as I've been saying quite often, it's the outlook for the coming quarters which is keeping everybody satisfied that, okay, there's no train wreck on the earnings side. So there is a 2.5% earnings growth, positive earnings growth for Q2, and a double-digit earnings growth, close to 11% for the second half of the year.
Right.
Now, companies don't usually provide guidance for the rest of the year. They may talk in qualitative terms about the rest of the year, but those who do provide guidance do guide you for the next quarter. We'll see how they guide towards for Q2, and if that 2.5% positive earnings growth start coming down, that'll be my prompt that yes, the expectations have been high and they are coming down.
And that's what would add the drag to the market.
Yes, it's about the outlook for earnings, and as that outlook starts shifting, that's where you want to see how stocks will respond to that, and that's going to be negative.
Okay, Kevin Matris, this is the first earnings season that's being reported since the fiscal cliff.
Right.
You're a little bit more optimistic than these two guys.
I don't know if I am. The one thing that I know is that if you were to look at the last couple of years, each and every earnings season on average has been very accretive to the market. I mean, it would pick up on average of like 5%. So, you know, I'm hoping that we see the same kind of stuff again this year, especially since, you know, expectations have been so low. However, though, knowing that earnings season has typically coincided with a nice bump in the market, we keep on not being able to break out to new highs in the S&P. So if there ever was an opportunity for the S&P to bust out to brand new highs, now would be that time. So my belief is if we cannot get through 1575 this earnings season, I think we're going all the way back down to 1475 before the market, you know, can rally enough and try to then retest new highs. So this earnings season, in my opinion, is going to be very critical. Technically, we need to see a catalyst get that S&P over those, you know, into the new highs like the other indices did. So a lot of eyes are going to be watching this earnings season.
Well, so far, 2013 has been a big year for stock buybacks. And as far as what that is telling us about the entire market rally, Shiraz, you say it's a net positive.
Well, it's a net positive in the sense that investors need a capital return from the management teams and from the boards. You could have that return either in the shape of dividends or in buybacks. We have been seeing a lot of dividend increases too. So buybacks to the extent that it increases cash returns or returns to shareholders, is a net positive, and it supports stock prices.
Okay. So, Kevin Matris, you also look at it as mildly bullish.
Well, a lot of people think, oh, the company's going to buy their stock back. Well, it must be a great value. They think it's undervalued. But if you were to take a look at the history of stock buybacks, they're not that great. There's no real big catalyst. There's very little correlation between a stock buyback and the predictiveness for future returns. One could even make the argument that it's, if a company's best investment is simply to buy their shares back, I mean, that's not really exciting for the prospects for immediate future growth. I'd much rather see a company try to invest in other things as opposed to just simply buying their shares back. Plus, most of these share buybacks, it takes years. I mean, they have this huge window. They buy these things incrementally, so I don't see that as any great chance.
Okay, Eric, you think that it reflects the money manager's thoughts?
Well, basically to completely disagree with what Kevin just said. There's actually an ETF out there that tracks a bunch of companies that have bought back at least 5% of their stock in the trailing 12 months. PKW, it's by PowerShares. And this fund, year to date, has actually gained about 12 or 13%. So it's really been performing quite strong. And over the past couple of years, it's been beating out the broad market as well. So I don't really know about this, not much of a history of overperformance, because that's what we've been seeing, at least in this, obviously very specific fund.
Shiraz, you want to jump in? You can.
Bottom line question is, does this strong showing on share buybacks, does it help the market rally at all? Does it do anything to add positive impact?
It doesn't hurt it, but let me just say that 12% is hardly an accomplishment when you consider the S&P is up 10% and some of the other indices are up even more. So I'm not all that, tripping over myself with excitement.
Okay.
Yeah, so it supports stock prices, but it's in confirming and in agreeing partly with his explanation. When management teams consider buying their stock as the best use of their cash and not investing in plant and equipment and other capital, that tells you about the outlook for the broader economy.
That's a good point.
And that's what we are seeing in aggregate data too. Capital investment has been kind of iffy and weak. So companies are not investing there and instead buying their own stocks.
Okay, circling back to earnings season real quick. I'm going to give you the final word. Big earnings story this week, not Alcoa, but actually J.P. Morgan and Wells Fargo.
That's right. So the bank results coming out on Friday, that's the big story. We want to see the loan growth. The mortgage business should be doing good. Capital markets is big for J.P. Morgan, not so much big for Wells Fargo. But these are the best run banks out there.
Right.
So we will likely get pretty good results from these guys, but that should not be extrapolated to what should be expected from Citigroup and Bank of America and others next week.
Okay, thanks for that. We still have top stock picks to run through with these gentlemen, and that is in our next segment.